So right now I'm gonna show you guys or tell you guys how to calculate your housing expenses. So that's your housing expenses for your mortgage. So when you buy a home, your total monthly housing expenses is usually referred to as PITI for principal, interest, tax, and insurance. So each of them are different. So the principal is the amount of money that you borrowed that you will repay every month. The interest is the cost of lending you that money. Okay? The taxes is Uncle Sam's part. You have to pay taxes. Insurance is the money you pay to insure your investment. Now, insurance you have to get because if your house burns down right after you buy it, the bank needs to get paid. So the bank is gonna get back their money. But insurance insures your investments. There's two ratios used when you're getting your mortgage. You have the front end ratio and the back end ratio. Now the front end ratio, it should go as far as up as 28%, but different lenders use different numbers. I believe NACA uses 26% for the front end, and the debt ratio is 36%. I believe that's what NACA uses. How much you pay every month? Lenders start with two ratios, front end and back end. The front end ratio is sometimes called the housing expense to income ratio. Lenders usually want the front end ratio to equal 28% of your gross monthly income. The back end ratio is your monthly housing expenses once you buy your house plus the minimum monthly debts. This ratio can be as high as 36% of your gross monthly income. While different lenders may use different ratios, these ratios will give you a sense of what you can afford and what will you pay each month once you own a home. So I'm gonna tell you how to calculate it. So if you get paid weekly, you're gonna the amount you get paid, so if you get paid $10 an hour, let me get my calculator. Say you get paid $15 an hour. So you're gonna go 15 times 40. That's what you get paid. You get paid $600 per week, right? Then you're going to multiply that by 52 because there's 52 weeks in the year, which is 31,200. Then you're going to divide that by 12 because there's 12 months in a year, and that's going to be 2,600 that you get paid monthly. Now if you get paid bi-weekly, you'll do the same thing. $15 times 80 because there's 80 hours in 2 weeks, times 26 because when you divide 52 by 20, that's how they do it, 26. That's for the year, and then you divide that by 12 and the same number. You do it monthly. Nobody gets paid monthly in America, so it's only bi-weekly or weekly. And then you're gonna put your total that you get for the year, your total monthly gross income. So in this case, it's gonna be 2,600 is your monthly gross income. Then if you're paid by cash, self-employed, same thing. So if you have other income, you're gonna put those down, and you're gonna add that other income to your total gross income from your job. So if you have other income from public assistance, you work overtime, you pension, social security, other, as long as you could document it, you could use it. So your total income with your job and other income is gonna be A, okay? So then you're gonna go over to your debts, and you're gonna add the minimum payments for all your debts. So if you have student loans, the minimum payment, car loans, the minimum payment, personal loan, the minimum payment, revolving debt, credit cards, the minimum payment on all the credit cards, other debts like child support, how much you pay, wage garnishment, how much you pay, alimony, how much you pay. And you're gonna add up all that debt, and then that's gonna be B. Okay, that total amount is gonna be B. So you have A is all the income, your income and your other income total. B is your total debt, right? And then you're gonna have three lines. You're gonna have A and B, and then you're gonna have C. So you're gonna write down your total income on line A, your total debt on line B, your total income plus your debt is gonna be line C. Okay, now you get down to the housing ratios. So for the front end ratio, I'm using 26%. You're gonna have your total gross income, which is line A, your total gross income times 0.26. That's gonna equal your maximum housing payment. That's what you could pay for your house, maximum, right? That's what the lenders use. You can't go over that number. So for your debt to income, you're gonna have your gross income times your debt ratio, which is 36%. That's gonna be your maximum housing payment plus your debt. Again, you can't go over that number. You could go under it, but you can't go over it because the lenders won't give you the money. Okay, so they say if line, so I'm not, that's confusing. So okay, those numbers are the numbers lenders use. Now there's other things that the lender will not include in your ratios, but they impact your monthly expenses, like child care. They don't calculate that in your ratios. They don't calculate medical insurance, and they don't calculate tithing to church, like giving money away to charity. They don't calculate that. They don't calculate your spending habits. If you eat out, if you buy expensive stuff, they don't calculate all that stuff. So you're gonna have to know your lifestyle, because they only could calculate stuff that's on your credit, stuff that is tied to your social security number, that they could see. That's what they'll calculate. So if you owe your mom $5,000 and it's not on your credit, hey, nobody, only you know that you're supposed to pay that money. Nobody else knows. So you have to keep those things into consideration. But if you want a idea of how much it's gonna cost you, do these ratios. Gross income times your housing ratio, which is 26% for the maximum payment, and gross income times your debt ratio for your max housing payment plus all your debts. Hope this was helpful. Comment, ask me questions, ask me to clarify, and I will. Have a good day. Bye.